Legendary investor Warren Buffett is a man that needs no introduction. Possibly the most talked about investor on the planet, Buffett's methods have long been the subject of study and conversation. At the helm of the legendary Berkshire Hathaway and with Charlie Munger at his side, he has managed to create an unassailable institution that has stood the test of time through the rapid growth and geopolitical turmoil of the latter half of the 20th century. Just to put some numbers to this, one share of Berkshire Hathaway was worth $4,000 in 1988. In 2013, though, that share would have been worth $143,000. In 2022, that share would have been close to $470,000. In fact, the company's historical compounded annual gain from 1965 to 2020 amounts to almost 20%, nearly double the performance of the S&P 500. Berkshire stands today as a behemoth with a diverse portfolio of companies under its umbrella and significant holdings in cultural titans like Coca-Cola and Apple, and Berkshire is also the owner of Geico, Duracell, Dairy Queen, and many other long-standing businesses, alongside minority holdings in public companies like Kraft Heinz Company and American Express. And yet, at its fundamentals, Buffett's investment strategy is composed of very simple principles. We are now well into 2022, and with uncertainty looming on the horizon, maybe it's time we revisited these principles. After all, we find ourselves in an era of volatile crypto markets, unrealistic valuations, and the aftermath of years of zero interest rates and uncontrolled money printing during the pandemic. Let us not forget the alarming inflation figures we're also seeing. The growth of the workforce and of business output has been stifled considerably by the pandemic and by stimulus spending. On the supply side, most businesses, whether they are in fast food or in manufacturing, are finding it hard to retain employees given universal demands for more competitive wages. On the other hand, for most of us sitting at home, the situation has left us with money to spend, and with interest rates having been so low for most of the last 2 years, we are also able to borrow money for cheaper than ever before. With these two opposing factors in play, and with newly released figures from January 2022, it seems clear that inflation isn't going away anytime soon. A little extra help from arguably the world's top investor wouldn't hurt. Now, before we dive into some essential recommendations for future investments that we can pick up from Buffett's wealth of experience, it is essential for us to understand two concepts: value investing and the efficient market hypothesis. If you know the true value of something, you can save a lot of money when you buy it on sale. This is most directly visible in purchases of things like electronics or cars. If you were to purchase a car at a showroom during a sale, you would still expect the specifications to match those of the cars being sold for the default price. Thus, at its core, value investing is an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic or their book value. The efficient market hypothesis, on the other hand, states that all asset prices in the market are priced according to their inherent properties, and that perfect information is always made available to all participating entities. Of course, this is a dubious statement at best. At worst, it is blatantly untrue. As Buffett says in his letter to shareholders for 2020, investing illusions can continue for a surprisingly long time. Wall Street love the fees that deal making generates, and the press loves the stories that colorful promoters provide. At a point, also, the soaring price of a promoted stock can itself become the proof that the illusion is reality. It's pretty clear that Buffett detests Wall Street's tendency to overvalue stocks and use inflated prices as proof of underlying value, instead of the other way around. This is a direct contradiction of the efficient market hypothesis. In fact, this dichotomy is something that most value investors resolve by categorically rejecting this hypothesis. In the short run, a market is a voting machine, but in the long run, it's a weighing machine. This is Warren Buffett's quoting a maxim by Ben Graham, the man most, including Warren himself, consider the father of value investing. In fact, Graham's teachings have shaped Mr. Buffett's philosophies to such a degree that the latter considers Mr. Graham the second most influential figure in his life after his father. The direct implication of this statement is clear. While in the short term, market volatilities and public opinion might shape the movement of stocks, in the long term, businesses that are intrinsically valuable will win out in the market. That is because, in the long term, the ability of a company to withstand years or decades of economic movements is judged, and not sporadic trends that are overly optimistic about the company's trajectory. This kind of value is primarily judged by the company's financials and other fundamentals. The value investor generally tries to analyze all publicly available information regarding a business to determine if a company is undervalued by the market as a whole. This includes official documents such as earnings and income statements. More importantly, though, they rely on the belief that stocks going up and down prompts an overreaction from the market. Taking both of these processes into account, it is possible for the value investor to analyze significant market events and determine the moments where the liquidation value of the stock is most discounted from its intrinsic value. This means that at certain junctures in the market, there exists a margin of safety for purchases of such undervalued stocks. Now, if you're worried about inflation like me and you're thinking about diversifying your portfolio with gold, then Vaulted is the best way for individual or even institutional investors to acquire physical gold with a great website and mobile app that makes it easier than ever before. They store and insure their gold in the Royal Canadian Mint. It's all real one-to-one allocated gold manufactured by the Royal Canadian Mint and certified conflict-free, meaning that you can rest easy in the knowledge that you can request instant physical delivery of your gold holdings wherever or whenever you desire. Their prices are the best in the market because they store all of their gold at the manufacturer and they cut out all unnecessary middlemen. They don't charge any premium or spread when buying or selling you gold, and they are as transparent as possible, meaning there are absolutely no hidden fees. On top of all that, they even manage to put out some great articles to keep you updated on the investing world. Now, if that sounds interesting at all, if diversifying your portfolio is important to you, then I highly suggest you check Vaulted out. There's a link for you down below in the description and in the comment section for you to check out. Now, Warren Buffett often compares the margin of safety to driving across a bridge. You have to have the knowledge to enable you to make a very general estimate about the value of the underlying business, but you do not cut it close. That is what Ben Graham meant by having a margin of safety. You don't try to buy businesses worth 83 million for 80 million, you leave yourself an enormous margin. When you build a bridge, you insist it can carry £30,000, but you only drive £10,000 trucks across it, and that same principle works in investing. In Buffett's case, this means that any momentary ups and downs in stock prices don't affect his long-term strategy. Instead, Buffett and other value investors use a few parameters to evaluate the earnings potential of a company and therefore the possibility of investment. These include company performance. Primarily, Buffett analyzes if companies have been providing a positive return on equity. The longer the period of sustained and positive ROE, the more likely Buffett is to consider that company's stock more valuable. Companies that have been providing a positive and acceptable return on equity for many years are more desirable than companies that have only had a short period of solid returns. Ideally, it's recommended that an investor analyze ROE figures for at least the preceding 5 to 10 years in order to accurately assess a stock's desirability. Secondly, we have debt to equity ratio. Growth driven purely by the addition of more debt is instantly off-putting. In fact, in Buffett's view, as the company's earnings are largely allocated towards servicing that debt, this is not a desirable situation to be in. Instead, Buffett prefers earnings growth to come from the shareholders' equity. A company with positive shareholders' equity means the company generates enough cash flow to cover its liabilities and it's not relying on debt to keep it afloat. Next, we have profit margins. Buffett looks for companies that have a good profit margin, especially if their margins are growing. As is the case with ROEs, he examines the profit margin over several years to discount short-term trends. Buffett is always on the lookout for signs of efficient management, and year-over-year growth in profit margins is a sign that management is also good at keeping operational expenses low. Next, we have comparative advantage, uniqueness, the value of intangibles such as a brand's name, the uniqueness factor of the company's products, and even the quality and integrity of the management is also taken into account to compute the intrinsic value of a business. Buffett considers companies that produce products that can easily be substituted to be riskier than companies that provide more unique products and services. For example, a tech product that is based on some proprietary algorithm or engine, in this case, the company's proprietary tech could be a competitive advantage that helps it earn profits. Another example could be a marquee brand which has a competitive advantage by virtue of already being a popular brand that most engage with. In summary, Buffett emphasizes buy and hold style investments. As he has said before, the most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd nor against the crowd. Following this principle, Buffett is not interested in selling stock in the near term to realize capital gains. Rather, he chooses stocks that he believes offer good prospects for long-term growth. This means he doesn't care about market hype, he just objectively looks at the company's future earnings potential and the degree to which the company's stock is currently discounted. But what does this really all mean for retail investors? Well, applying these methods to the overvalued market conditions that we find ourselves in yields some interesting insights. There is no doubt that the markets have been significantly overvalued for the last few years. While low interest rates often accompany rich valuations, low rates do nothing to mitigate the poor long-term stock market returns that follow. At the end of of the year of 2021, the stocks in the S&P 500 were trading at a price-to-earnings ratio of 30 based on trailing 12-month reported earnings, making them very expensive by historical standards. Now let's take a look at another interesting metric. Warren Buffett's favorite valuation metric is a simple ratio of the total US stock market capitalization to annual GDP. It's known now as the Buffett indicator. It is similar in purpose to the S&P 500 PE ratio, which functions as a reference point for current prices. In an article for Fortune magazine published in the year 2021, 1 year after the dot-com bubble popped, Buffett said the ridiculous highs of tech stocks should have served as a warning signal. In his own words, if the ratio approaches 200%, as it did in 1999 and a part of 2000, you are playing with fire. In March of 2000, the Buffett indicator stood at a percentage of 159%. As of the 31st of December 2021, the Buffett indicator stood at 229%. These are clear indications that there is a speculative bubble here, that it is waiting to burst. Post the 2008 recession, interest rates were driven to near zero. Of course, the consequences of this decision are finally showing up. That speculation front-loaded more than a decade of future market gains into the present. If history is any guide, a collapse in valuations is likely to occur. If the present is any guide, this process has already begun. The process of losing speculative gains and recovering them over time is cyclical and is a natural market correction meant to ground investors who have a proclivity for unsustainable ambition. Indeed, when the investment horizon begins at extreme valuations and doesn't end at the same extremes, valuations themselves will shrink entirely to more closely align with the fundamentals of the companies in question. Of course, modern investment rhetoric emphasizes growth over all else, and juicy valuations make questioning the status quo particularly unappealing. However, it would be best to take this received wisdom with a grain of salt. Given that market internals, fiscal subsidies, and the Federal Reserve's attitude for recklessness have all turned against this speculative bubble. Investors are paying top dollar for top dollar, and it doesn't even make sense. As quoted by the man himself in his annual letter to shareholders of 2020, investing illusions can continue for a surprisingly long time. Wall Street loves the fees that deal-making generates, and the press loves the stories that colorful promoters provide. At a point also, the soaring price of a promoted stock can itself become the proof that an illusion is a reality. What then does this really mean for the average retail investors? Where do we park our money with such absurd valuations on the table? Well, taking a page out of Buffett's book, the prudent investor that understands our current circumstances should aim to be cautious above all else. One way to be cautious above all else is to avoid value traps, which are stocks that look like they are discounted, i.e. they're on sale, even while that may not be the case. In industries that are heavily reliant on seasonal earnings, it's easy to get carried away while studying earnings patterns during the on-season. After all, when earnings fall during the weaker part of the business cycle, the margin of safety shrinks. Additionally, stocks that are highly valued due to intellectual properties also have a high chance of becoming value traps. This is most apparent for companies in tech where the barrier to entry might not be high enough to protect against the competition. The crux of the value investing thesis is that the real money is not made when buying or selling, but rather when you can identify potential winners in the market and hold their stock, therefore sharing in their prosperity as they grow. Of course, this isn't really a strategy most retail investors can engage with. Most of us don't have the ability, the time, or the technical resources to perform a fraction of the research that Berkshire does to understand the intrinsic value of stocks. More importantly though, we don't have the vast cash reserves that Berkshire possesses, approximately $70 billion for the quarter end in September 30th, 2021, to act as a cushion against loss-making investments. This is why, for most individual investors, Buffett explicitly recommends passive investing as the financial strategy that makes the most sense. The beauty of this approach is that the individual investor doesn't have to throw their hat in the ring to collect and analyze multiple perspectives on the short-term prospect of stocks. Instead, they can distribute risk by not making too large of an investment at any given time and instead follow a dollar-cost averaging approach to investing in stable assets such as index funds. In a sense, Buffett is actually suggesting that there is no need to look at the volatilities of individual stocks when you can just follow the bigger picture. Of course, this means that it takes years, if not decades, for these investments to really bear fruit, but for the working investor, there is no better method to create long-term wealth. Indeed, as Buffett has often opined, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Most importantly, this means individuals can continue on as normal, despite the corrective economic circumstances we can expect over 2022 and 2023. The consequences of the Fed playing fast and loose with monetary policy are here. It's no secret that the current inflationary climate is alarming. Indeed, by buttering up starving investors with near zero interest rates, we've reached a juncture where just a week ago, we saw inflation rise to a 40-year high of 7.5%. Berkshire's second-in-command, Charlie Munger, addressed this phenomenon at the Daily Journal annual meeting, where he warns of the possible long-term consequences of this environment. The pandemic has done us no favors as well, with severe supply chain shrinkage causing many experts to predict downturns as early as 2023, with the possibility of a full-blown recession on the horizon by 2025.
We do know from what's happened in other nations, if you try and print too much money, it eventually causes terrible trouble. And we are closer to terrible trouble than we've been in the past, but it may still be a long way off. I certainly hope so.
Charlie, I'm going to ask a couple more of these inflation questions because it's in a similar vein, but they're nuanced and there's slightly different aspects. This is something from Simon Jacobs, who says, conventional economic theory argues that excessive monetary and fiscal stimulus over the last 2 years has triggered the highest inflation in 40 years. Do you broadly agree with this thesis? And more importantly, do you think there will be a high economic price to pay as the Fed attempts to bring inflation back under control? I guess the reasons for it.
Well, the first part, I agree with it. We've done something pretty extreme, and we don't know how bad the troubles will be, whether we're going to be like Japan or something a lot worse. And what makes life interesting is we don't know how it's going to work out. I think we do know we're flirting with serious trouble. I think we also know that some of our earlier fears were overblown. Japan is still existing as a civilized nation, in spite of unbelievable excess by all former standards in terms of money printing. Think of how seductive it is. You have a bunch of interest-bearing debts, and you pay them off with checking accounts, which you're no longer paying interest. Think of how seductive that is for a bunch of legislators. You get rid of the interest payments and the money supply goes up. It seems like heaven. And of course, when things get that seductive, they're likely to be overused.
Now over here, Munger tries to play down any sensationalism by clarifying that it's possible that the future is not bleak, but he does stress that it is important to remember that obscene amounts of money being printed is always a risky state of affairs. Of course, making the best of a bad situation means being prepared for the worst case scenario. As per Buffett and Munger's school of thought, this means two things. The best stocks to choose are those by businesses that can cope with inflation by being able to increase prices without fear of significant loss of either market share or unit volume. What kind of businesses can do that? Well, companies that have marquee products or have already captured a market, such as FMCG brands or luxury commodities, or businesses that have a wide competitive moat. They are generally a few good bets. After all, cultural importance attached to everyday commodities, or in the case of luxury commodities, the prestige associated with them, means that buyers will always exist for these goods, even as unit prices increase. Secondly, amidst inflationary circumstances, it is also important for investors to analyze the ability of the business to scale. This is easier for some businesses than for others, of course. Businesses that are physical, asset heavy, like manufacturing, tend to require more capital to scale. They have to open up factories, extend their supply chains, deal with the additional labor overhead. In contrast though, companies that rely on soft products or are purely service-oriented can scale far quicker. With these principles in mind, it is possible to develop a holistic approach towards investing in an environment where inflation is rising and will most likely continue to rise as well. But what about investing during a period of decreasing valuations? The interest rate hikes have hit. They're here and they're going to continue as well. This most likely means that valuations in the equity markets are going to be seeing a steady decline. This makes sense as institutional investors and fund managers see interest rate hikes as an opportunity to make continuously increasing assured returns on government bonds. As this trend catches hold, slowly but surely, money flows out of the equity markets, causing an overall reduction in valuations. Unfortunately, in this kind of situation, the priority really is to choose the least terrible option from an array of options. In this situation, the Buffett-Munger approach generally concludes that the most prudent investor would probably be better off just focusing on holding stocks that have proven performance and are well established. In essence, companies with a substantial margin of safety would probably be your best bet. This means that as interest rates rise, a few key sectors are worth looking into when planning investments. These usually include financial service companies like banks and brokerage firms where interest rates directly drive revenue. During previous interest rate hikes by the Fed, many financial services companies saw their operating profit margins actually go up. Companies with significant cash reserves in the form of either low debt or equity or large percentages of book value in cash. An example of this category would be payroll processing companies, companies that tend to hold on to retained earnings rather than pay out dividends. This is particularly prevalent in tech and healthcare. Past performance shows that during periods of rising interest rates, the healthcare and technology sectors experienced average gains that outperformed the S&P 500 index. Beyond these general tips, however, the crucial point here is to be ready to weather the storm. Ships will sail around the world, but the flat earth society will flourish. There will continue to be wide discrepancies between price and value in the marketplace, and those who read their Graham and Dodd will continue to prosper. This is a direct quote from an article by Warren Buffett called The Super Investors of Graham and Doddsville. It is clear that, according to Buffett's perspective, the principles of value investing have always been evidently simple, and yet both academia and the market have largely sidelined this philosophy. Perhaps this is due to the way the philosophy doesn't pursue outsized gains in the short term, or perhaps it's due to the market attraction towards speculation-driven investing. Either way, there seems to be no question that keeping an emphasis on the intrinsic value of prospective stocks is wise, given our economic climate. To the retail investor, it seems to me that Buffett's message is clear. Steady and continuous passive investing is the best way to be investing for 2022. In conclusion, move focus away from what others are doing. Instead, look at whether a company is in a solid position to make money moving forward and if the stock's pricing is reasonable. The waters of the market are definitely rocky, but with these principles in mind, navigating the unpredictability of short-term market events doesn't seem impossible. There really is no magic formula to crack the market's secrets and make outsized gains amidst such circumstances. But while gains in the upcoming years may be lesser than expected, patient and methodical investors should be able to prime themselves for further wealth generation and keep pursuing their long-term financial goals. On one closing note, I would like to remind everyone of a famous quote by Buffett that says, "The stock market is a device for transferring money from the impatient to the patient." With that said, remember to always keep your wits about you, and remember that tough economic times do not last, but tough investors do. Now, if you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world-famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.